I mean, the fact of the matter is, there really can be no response there from the Fed, can there, right? Inflation, they can't cut rates if it goes up. Unemployment, if, that goes up as well, they also can't cut rates because of inflation.
That's absolutely right. And what is so unusual is that Jay Powell pointed out that they expect inflation to go up, as you're saying, Martin, and they also expect unemployment to go up. Normally, that's not what we see. Normally, you would expect that if inflation goes up, then the unemployment rate should be going down. But that's not what we're seeing at the moment, because this is a stagflation shock where the trade war has simply hit the U.S. economy in a way where goods are going to become more expensive in the U.S. and at the same time, sales in the U.S. is going to get weaker. So that's why the Fed is stuck in this very difficult spot. Namely, as you're saying, should they be looking at inflation? Well, if that's the case, inflation is going up, so they should be hiking. Or should they be looking at growth slowing down? Well, if growth is slowing down, they should be cutting. So that's why they are really torn between the two parts of the dual mandate here.
Yeah, you got to feel for the Fed, right? Because they have no choice and they can only be reactive. The principal actor that can make any difference at all, of course, is President Trump. And he's pretty clear just moments ago saying that, look, I'm not backing off on those 145 tariffs. We'll see what happens with those talks in Geneva. But, the Fed as a backstop for the economy, for markets, et cetera, there are a couple other things they could do, and I think they started doing one of them, which is stealth easing in terms of easing back on the taper of their bond buying, quantitative tightening. The other two things they could do, obviously, is the SLR, supplementary lending ratio. A, do you think they're going to move on that as well because they have so few other mini tools to work with? And B, and I got to put this out here, right? We saw what happened in April, right, with the bond market. Is it going to take something as bad as a liquidity event, a credit crisis, to force the Fed to action and to cut rates? What do you think, Torsten?
Yeah, no, and that's absolutely correct. They have some tools other than lowering or raising interest rates. But exactly as you're saying, the supplemental leverage ratio is one way of allowing banks to hold more treasuries, and therefore one very slight way of trying to ease monetary policy a little bit more. But it's nowhere near as effective as it would be that if they would be cutting interest rates. And the challenge is that even if they do any easing in any shape and form, even with forward guidance, then the fear, of course, is for them is that inflation and inflation expectations begin to move higher. So that's why they are really stuck in a difficult spot. That the data so far, as Powell also talked about today, it is actually still pretty okay. But the worry is that through this earnings season that we just have had for the last several weeks, we've heard a number of companies come with relatively weak forward guidance. We heard, for example, Southwest Airlines say that we are already in a recession. Chipotle said that traffic in their businesses were relatively weaker. And we also saw PepsiCo say that snack sales is relatively weak. So the backward-looking data is okay. But as you just also said in the clip you just showed, we could move quickly. If the economy does begin to slow down, then, of course, they would also have to move faster than what they're saying at the moment.
Could move quickly. Here's the thing, Torsten. I mean, tariffs, if they do not move quickly to end, right, if things continue the way they are or potentially even get worse, right, you're pricing in, you've crunched numbers and you see a 90% chance of recession, correct? So, how much movement do you think we're going to see in those talks set to start in Geneva this weekend?
Yeah, so that's a very important question because at the moment, in particular, 145% towards China is very damaging for the U.S. economy. You are seeing in particular a lot of small businesses that are impacted. For example, independent toy stores across the country who do not have the operating capital to go and pay for the tariffs when the goods arrive in Los Angeles. For example, also hardware stores, clothing stores, even fireworks stores are being impacted simply because they don't have the working capital to pay for the higher levels of tariffs that we're seeing at the moment. So we are worried that the implementation of the policies that we're seeing on the trade war front is going to create what we have called a voluntary trade reset recession. In other words, a recession where the adjustments that are required for the U.S. economy is going to be so substantial that it will result in a recession. Simply because, remember, the main statistic here is that 80% of employment in the U.S. economy is in businesses with less than 500 workers. So that means that if 80% of the U.S. economy is small businesses, they are hit particularly hard, including also those who sell things on Amazon, because goods from China play a very important role in the U.S. economy.
Torsten, the price reaction to these tariffs has, I got to say, just been weird, right? Yeah, you would expect yields to go up. No, you wouldn't expect dollar to go down. We talked to Jeff Gundlach, the bond king, over at Double Line. I want to play you a soundbite of what he said about this weird mismatch here, and we'll continue talking. Take a listen.
As the economy weakens, long-term interest rates could very well be going up. And that's very different from most people's experience. Even if you have 40 years of experience, like I do, most people say when there's a recession, the dollar goes up and interest rates go down. But actually, the opposite has happened this time. And I don't think that that's just a coincidence or a one-off. I think that's going to continue.
Torsten, you know, Sherry and I have been talking about this for days now, right? Is this a reflection of yields going up, demanding more to hold the risk of having U.S. assets, and also dollar going down? Is this simply a reflection of this, sense of exorbitant privilege that the dollar has had as a reserve currency for years now? That is fading. Basically, the outside world is losing trust in America.
You can have exactly the fears that there is something going on, at least temporarily, where foreign investors are beginning to ask questions. And that is, of course, the worry that we can all have in markets, that it is not, as Gundlach is saying, and as you're pointing out, Martin, it is not the case that normally you should see the stock market go down and interest rates go up at the same time. It should be the case that when the stock market goes down, you sell your equities, you take the money and you put it into the bond market, and as a result, interest rates should also be going down. So this inverse correlation we've seen, in particular after Liberation Day on April the 2nd, including when it comes to the dollar normally is driven by interest rate differentials, but after April the 2nd, the dollar has been much less connected with interest rate differentials, and that does tell you that there's something else going on. I do not think that this is a permanent change. I do think that once we begin to talk about other policies than trade war, then I do think that we will get to reestablish some of the old correlations we had, but it is very clear at the moment that there are a lot of things going on in financial markets that are rather unusual relative to what we've seen, not only for the last decade, but really for the last 30, 40 years.
Yeah, and Torsten, I think it's safe to say that a lot of people agree that there will be some kind of contraction in economic activities, but it's coming from the supply side because of the tariff-induced shock here. Many are comparing this to COVID times, but back then, actually activities picked right back up because the demand was not damaged in any way then. So do you see some kind of a COVID-era reminiscent kind of activity coming back up down the road?
That's right, Sherry. This is really, really important. There are a number of things, of course, that are similar. What is most similar is, of course, we have supply chain challenges. Normally, there's about 30,000 containers that arrive from China to the U.S. every single day. So if now that has been dropping by roughly 50% over the last several weeks, that means that we have much less goods coming into the U.S. And that indeed looks very similar to what we saw during COVID. So the consequence of that is that goods inflation is likely to go up. But the difference is that service sector inflation is going to behave very differently this time around relative to what it did during COVID, because service sector inflation during COVID was basically going down because there was no activity in the service sector. We were not going to restaurants, we were not staying at hotels, we were not flying on airplanes. But this time around, goods inflation is going to go up, and meanwhile, the service sector is still doing well. And that's the additional challenge for the Fed and Jay Powell, namely that it used to be the case during COVID that goods inflation went up and service sector inflation went down. But now you're both seeing goods inflation go up, and we are still flying on airplanes, still staying at hotels. All that means that there's also upward pressure on service sector inflation. So there are some parallels to your point, Sherry, here, but there are also other areas where we have some very important differences.